Hello and welcome back to our weekly tea break series here at the FT headquarters in London. Unfortunately, my co-host Yuri Bender is not here. He's away on other duties, but he'll be back next week. Today, I'm delighted to welcome Miguel Burguet, Managing Director of Marlowe Capital, a macro investment manager focused on the US banking industry. Previously, he was a research associate at the Systemic Risk Centre of the London School of Economics. Miguel, how are you?
Very well, thank you. It's a pleasure to be here.
Earlier, before the show, you were talking to me about how you suddenly became an Earl Grey kind of tea fan just before the show.
Yes, well, it's here. It's because it transmits like a serenity and calm to me, which I think will be needed during the next 3-4 years.
A lot of talk has been in the last week about the US elections and this surprise victory for Donald Trump. In the aftermath of the 2016 US election, investors coined the term Trump trade, to describe the market's euphoric response to promises of corporate tax cuts, deregulation and infrastructure spending. Fast forward to today, while Donald Trump's election victory brings back that rhetoric of that era, the macroeconomic backdrop has shifted dramatically. The Trump trade may look very different at this time around, Miguel.
That's to be seen during next month. What the Trump economic plan is a boom, right? So we come from a situation, from a macro financial picture with the Democrats, in which the banking sector was quite tightly regulated, the macro variables were more or less under control, and the fiscal deficit still quite high, but nothing catastrophic. So there is a space for a plan that wants to generate a boom, which is probably what we will get if there is a combination of higher import duties that are financing internal tax breaks, and that goes together with a financial deregulation. So in that sense, the upside on the what happened after the victory of Donald Trump, I would say is justified, and it's not a one-off. It will probably continue.
And we had this beautiful article by Beat Whitman, chairman and partner at Porter Advisors. He kind of explored how Donald Trump's presidency redefined success in both politics and economics, with a focus on Wall Street's performance as the key metric. He says while Trump's approach may drive short-term equity market gains, the inherent unpredictability and extremism could pose significant challenges down the line. Do you agree with that?
Well, I mean, down the line, as Keynes said, on the long term, we are all dead, right? What we think it's on during next 3 years, such a plan, economic plan, is designed to generate a boom. There is a space for that because the financial sector was quite controlled under the Democrat administration. And in that sense, we've seen, if this is confirmed, just the start of an upside in the banking sector in the US. I think that right now, the American banks, the return on equity is around 10%, 11%. At the upper part of the cycle, it used to be around 17, 18 for commercial banks, more for investment banks. So there is wide scope for this boom to continue, at least in the financial sector. The valuations of Standard & Poor's are already quite high at 20-something PE, but there are some sectors that will fuel this kind of market expansion.
And in terms of let's compare here kind of election cycles. We just spoke about the 2016, how there might be some sort of similarities. But are there any other election cycles where you could pinpoint and say, hey, we could here make a kind of a similarity in some way?
Well, the similarity that strikes us most is a comparison with the Reagan deregulation. After the victory of Donald Reagan was a similar mix of tax cuts and strong investment, public investment on the Star Wars and so on. I mean, the difference with the Trump plan, one of the differences is that at that time the stock market had very low valuations. After the 70s, high inflation, so all companies were very, very reasonably priced. This is not the case at this point, but still in general macro terms, I mean, it looks like that could be an interesting comparison.
During past election cycles, the Federal Reserve, has walked a tightrope, and I'm sure balancing monetary policy against political pressures. I mean, I recall in 2020, Chair Powell emphasized the independence of monetary policy despite calls for lower interest rates. But in recent years, Trump has kind of flirted with the fact he might fire the Fed chair, Jerome Powell. And even Elon Musk, who's kind of been Trump's almost right-hand man in his election campaign recently, put this hashtag out recently and hashtag end to the Fed. I mean, some astonishing, bold claims there. How do you think this will play out? What are the ramifications here?
Well, the Fed is legally independent, but it has discretion. So there are different perceptions at the Open Market Committee of hawks, the doves. So within this discretion, there is potential for influence, perfectly normal. For example, bad press coverage, Congress scrutiny. So if I don't like direction that the monetary policy is taking, maybe I'll have a look at it, maybe not. And in the third case is because the heads of the regional Feds, Chicago, Texas, whatever, when they have voted at the Open Market Committee, they go back home and they have to explain to those people that elected them why they have voted what. And of course there are influences, perfectly lawful influences that can change things a bit. But at the end, the general play between monetary policy and fiscal policy, I would say, is difficult to change for good.
Is it a problem someone as powerful as Elon Musk having so much say in kind of maybe in Trump's administration now?
Well, he doesn't have a public role yet, so that has to be seen.
Yeah.
But let's say the institutions of monetary governance right now, they are independent. Of course, there are influences one way or the other, as they have always been. I mean, we'll see what happens in the future, but right now things seem to work.
And Miguel, as I sit here, I'm drinking my green tea. COP29, the global climate summit, is underway in Baku, Azerbaijan. And I'm sure green is undoubtedly on the agenda. And I wrote an article recently on kind of private banks are stepping up their bets on the circular economy. This cycle where materials never become waste and nature is regenerated. A lot of experts saying this is becoming a mega trend. But then on the flip side, you had UN Secretary General Antonio Guterres recently saying that 2024 has been a masterclass in climate destruction. And then if you couple that with what President-elect Trump has said previously, when it comes to oil, for example, he said, the term drill, baby, drill. How do you view the potential market and geopolitical implications of a renewed emphasis on oil and gas under Trump's administration?
Well, I think there will be, as in any other situation, winners and losers. So maybe the emphasis is more focused on the traditional, energy production. So some of the projects on the renewable energies, they might have less funding or less attention. So far, the financial sector at a global level has had a strong incentives to become more green, right? What are you financing? What's in your loan book? Which kind of companies are you financing? Which, in my view, did not have a big impact, because even if you stop financing non-green projects, if they are profitable, somebody will finance them. It looks like with Trump will be a shift to more traditional sources of energy, which will generate losers and winners, of course.
We had this lovely article written by Louise Findlay Wilson, Managing Director at Energy PR. She talks about greenwashing, where companies kind of understate or avoid discussing their ESG initiatives. And she says it's a growing issue with significant implications for wealth management and sustainable investing. You spoke there about financial services. Do you really think they're doing enough right now in that push for the green agenda? Are we seeing a major push, or is it kind of more talk, less action?
Well, there is an impact. I mean, in the European Union, they have some regulations, a taxonomy that banks have to follow. So there are a number of incentives which, so far, they do not seem to be having a critical impact, but there is a certain shift. But again, I mean, if a project is profitable in the non-green economy, you'll find somebody that finances it on exchange of a return. So that's having an impact, but not a critical one.
In a sense, that will clash with the current ESG-driven kind of dynamics of maybe Biden's administration. Kind of, you mentioned earlier, is it going to be a major shift, do you think, or not? That
is to be seen, but probably yes.
Yeah.
Looking at the program of the winner, right? Probably.
Well, Miguel, as we kind of digest COP29, I'm here drinking my green tea. I'm sure we'll be finding many ways to kind of reduce our carbon footprint in the next few days as well, or next few years as well. But Miguel, it's been a pleasure. Thank you for taking the time to speak to us today. That's all we have time today on our Tea Break series. Please join me next week with you, Renda, where we'll be talking more of these pertinent topics. Thank you.
Thank you. Thanks.